We note the high easing volatility in the gold market as the initial shock of the war in Israel appeared to be easing. Yet the situation remains volatile and could impact the markets should major developments occur. In this report, we aim to shed light on the catalyst driving gold's price and assets future outlook. Last Friday, the US employment data was released. The lower than expected non-farm payrolls figure may have been discouraging for dollar traders, as it implied that the labor market may be loosening. In theory, the loosening of the labor market may weaken the greenback as market anticipations of another Fed hike or prolonged interest rate pause may be put into question. As such, the aforementioned scenario may have provided support for the precious metal as a result of a potential weaker greenback. However, that appears to have not been the case, as despite the lower than expected NFP figure, the upwards pressures on the precious metal appear to have eased. The decline in gold, despite the weaker the greenback, could potentially be attributed to easing tensions in the Middle East, as talks about a potential ceasefire appear to be circulating from various media outlets. Furthermore, the initial shock of the war in Israel appears to be slightly fading away, and as such, the upwards momentum which facilitated ascent could be nearing its end. Although we believe that the situation remains volatile and could reignite at any moment. In conclusion, it appears that the dollar and the precious metal moved in their own separate paths, and gold's price may have been influenced by other factors, such as the lack of a full-blown regional war in the Middle East and apparent easing of tensions. In the event that the situation in the Middle East stabilizes, it may overpower the weakening of the greenback and could move the pressures to lower ground. On the other hand, should tensions flare up again, we may see safe haven inflows into gold. The US Treasury Yields appear to have moved in a downwards fashion since last week. In particular, the 10-year and the 2-year appear to have moved in a downwards fashion since last week. In theory, declining Treasury yields, which are interest-bearing, could result in a transfer of funds into the precious metal, which is considered to be a hedge during times of financial uncertainty. However, it appears that with easing market concerns of a potential recession in the US, market participants may be opting for more riskier assets, as their risk appetite may be increasing. Therefore, given that expectations of a recession are decreasing, the desire to invest in safe haven assets such as gold could be decreasing, whilst the desire to invest in riskier assets increases, which may lead to safe haven outflows from the precious. In conclusion, the assumed high risk appetite of market participants could be aiding in gold's descent, as the need to invest a safe store of value appears to be decreasing. Thank you for watching.